Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about BRIXMOR Property Group INC quarterly report. BRIXMOR, a leading real estate investment trust, REIT, offers a diverse range of businesses and services through its national portfolio of open-air shopping centers. Some of the key businesses and services provided by BRIXMOR include retail space leasing to over 5,000 retailers, property management for 360 retail centers across the country, ownership and operation of approximately 64 million square feet of prime retail space in established trade areas. These services cater to a diverse mix of national, regional, and local retailers, making BRIXMOR a trusted real estate partner to businesses across various industries. The stock price of BRIXMOR Property Group Inc. has increased by 1.51% in the last 12 months, driven by several key factors. The company's strong Q3 2025 earnings and increased dividend have contributed to its positive performance. BRIXMOR reported a 4% increase in same-property net operating income (NOI) year-over-year, reflecting strong operational performance. Additionally, the company updated its FFO guidance, affirming its same-property NOI growth expectations for 2025. Analysts have maintained a positive outlook on BRIXMOR, with an average one-year price target suggesting potential upside of 8.33%. The company's inclusion in Russell indexes highlights recognition of its stable cash flows and defensiveness in retail real estate. Furthermore, previous earnings beats and dividend rate increases have also contributed to investor confidence. Overall, these factors collectively point to a period of consistent operational strength, strategic financial management, and positive market sentiment for BRIXMOR Property Group Inc. Over the past year, the primary drivers of revenue growth or decline can be summarized into three main categories. Revenue growth is primarily driven by rental income, which increased by $20.6 million due to contractual rent increases and positive rent spreads for new and renewal leases. Additionally, depreciation and amortization expenses also contributed to the revenue growth. On the other hand, revenue decline was mainly caused by a decrease in tax increment financing income under other revenues, resulting in a decline of $0.5 million. Furthermore, impairment of real estate assets increased by $4,932, adding to the revenue decline. Other drivers that impacted revenue include leasing activity, occupancy rates, and changes in rental rates to be consistent with current market rates. However, these factors had varying effects on revenue growth or decline. The financial performance of the company experienced a decline in net income and profit margins from 2024 to 2025. Net income decreased by $20,947, or 2.62%, over this period. Profit margins also declined, with net income margin decreasing from 30.2% in Q3 2024 to 27.6% in Q3 2025. The reasons behind this decline are attributed to a decrease in net cash provided by financing activities and an increase in maintenance capital expenditures and leasing-related capital expenditures. These changes indicate that the company's financial performance was impacted by its investment decisions and cash flow management. The company's financial performance indicates a consistent trend of generating positive operating cash flow. The data from 2024 and 2025 shows an increase in net cash provided by operating activities, with amounts of $469,514 and $479,809 respectively. This upward trajectory suggests that the company is efficiently managing its operations to produce a steady stream of cash, positioning it for long-term financial stability. The company's debt level has undergone a significant change in recent periods. According to financial records, the debt level increased by $153,669 from December 31, 2024 to September 30, 2025, indicating a notable rise in debt obligations. However, this increase is somewhat offset by the repayment of $632.3 million principal amount of senior notes due 2025. In contrast, interest expenses have shown minimal change or fluctuations. While there are instances where interest expense increased, such as by $1.27 million and $4.6 million, these changes do not appear to be significant in magnitude. Overall, the company's debt level has seen a notable increase, whereas its interest expenses remain relatively stable. Management's outlook on the company is uncertain due to various risks and uncertainties, including changes in national and local economies, competition from e-commerce, disruption in the retail sector, and natural disasters. However, they anticipate that their cash flows will provide adequate capital for the next 12 months and beyond. The primary objective of the company is to maximize total returns to stockholders through consistent, sustainable growth in cash flow. To achieve this, they will proactively manage their portfolio, drive internal growth, pursue value-enhancing reinvestment opportunities, and prudently execute on acquisition and disposition activity. Management believes that their competitive advantages, such as expansive retailer relationships and a fully integrated operating platform, will enable them to succeed in the market. They also plan to fund future redevelopment projects with various sources, including cash, net cash provided by operating activities, and proceeds from sales of real estate assets. Overall, management is focused on navigating the company through uncertain times while maintaining financial flexibility and driving growth opportunities. The company has a history of paying dividends to its shareholders. In fact, it declared common stock dividends and OP unit distributions in both 2025 and 2024. Additionally, the company had $91.5 million in unpaid dividend payments as of September 30, 2025. Furthermore, the company also engages in share buybacks, with a significant available repurchase capacity of $400 million as of September 30, 2025. Supply chain concerns loom large. The financial summary highlights a pressing concern for companies: the risk of supply chain disruptions. Two key factors contribute to this worry: redevelopment costs and tariffs. These issues have the potential to severely impact businesses, making it essential for them to be proactive in mitigating these risks. That concludes the financial summary for BRIXMOR Property Group INC. Feel free to comment below, and I will be happy to answer them when possible.